Welcome, everyone. Today we are going to learn all about the exponential moving average trading strategy. This is a powerful tool that can help you identify trends, decide when to enter or exit a trade, and build a solid trading plan. By the end of this guide, you will be ready to use the exponential moving average to make smarter trading decisions. So whether you are brand new to trading or just looking to sharpen your skills, stick around because there is a lot to learn. Let us jump right in. Before we dive into the details, let me ask you this. Have you ever wondered how traders manage to catch trends early and make smart decisions about buying or selling? Today, we will explore a powerful tool that can help you do just that. Let us start with the basics. What exactly is an exponential moving average? It is a type of moving average that focuses more on recent price changes. Instead of weighing every day equally, it places more weight on the most recent data. Why is this helpful? The reason is that it allows you to see what is happening now instead of looking too far back. This way, you get signals that are much more in tune with the market. If you are looking for timely buy or sell signals, the exponential moving average helps you catch them faster. Now, let us expand on how chart patterns can enhance your use of the exponential moving average. Chart patterns are visual representations of price movement that help you understand market psychology and predict future price movements. Some common patterns include head and shoulders, double tops and bottoms, flags, and triangles. Recognizing these patterns alongside exponential moving averages can provide even more powerful signals. For example, a head and shoulders pattern is a reversal pattern that signals a potential trend change. If you see this pattern forming and it is confirmed by a bearish crossover in the exponential moving averages, it can give you more confidence that the trend is indeed reversing. Similarly, a double top pattern is a bearish signal indicating that the price has tried to rise twice but failed, often followed by a downward move. If a double top is accompanied by the short-term exponential moving average crossing below the long-term one, it is a strong sell signal. Flags and pennants are continuation patterns that indicate the trend is likely to continue after a brief consolidation period. If you see a bullish flag pattern while the short-term exponential moving average is still above the long-term average, it can signal a good opportunity to add to your position. On the other hand, a descending triangle is typically bearish, and if you see the exponential moving averages crossing downwards while the triangle is breaking lower, it could signal a strong selling opportunity. Triangles like ascending and symmetrical triangles also play a significant role in trading decisions. An ascending triangle is often a bullish pattern, and if it is followed by a bullish crossover of the exponential moving averages, it is a good signal that the trend might continue upward. Symmetrical triangles can break out in either direction, so watching for exponential moving average crossovers when the breakout occurs can help you determine the direction to trade. By understanding these chart patterns and using them in combination with exponential moving averages, you can significantly improve your ability to identify strong trading opportunities. Chart patterns can be thought of as pictures that tell a story about what the market is doing. For instance, a head and shoulders pattern looks like three peaks, with the middle one being the highest. This often means the market is ready to change direction. A double top looks like two peaks at about the same level and usually means the price might start dropping soon. Flags and pennants are smaller patterns that happen during a pause in the market, indicating that the price is likely to keep moving in the same direction once the pause is over. Using these chart patterns is like getting clues about what might happen next. The exponential moving averages help confirm those clues by giving a clear signal of when the trend is actually changing. When you see a pattern like a triangle or a flag, and it matches with a crossover of the exponential moving averages, you get a much stronger idea of what to do. For example, if you see a flag pattern and the short-term moving average is still above the long-term one, that can be a sign to keep your trade open or even add to it. The more you practice identifying these patterns, the better you will get at understanding what they mean and how to act on them. By combining the visual cues from chart patterns with the confirmation from exponential moving averages, you will be able to make more informed decisions, reduce your risk, and take advantage of market opportunities with more confidence. Now, let us talk about how you can use this in your trading. We will start by setting up two exponential moving averages, one for short-term trends and one for long-term trends. The idea is to combine both so that you get a clearer picture of what the market is doing right now. For a common setup, traders often use a 12-day exponential moving average for short-term trends and a 26-day exponential moving average for long-term trends. With these two lines, you can see how the short-term price movements compare to the longer-term trend. You will want to add these two exponential moving averages to your chart. Most trading platforms have them built right in, so it is just a matter of picking the right periods, like 12 and 26 days, and applying them to your price chart. You will notice two lines that move with the price, and these are your guides for making decisions. Let us take a look at how we can use these exponential moving averages to identify buy and sell signals. One of the most important things we want to see is what is called a bullish crossover. This is when the short-term exponential moving average moves above the long-term exponential moving average. It means the market might be gaining momentum, and it is a signal that a new upward trend could be forming. It might be a good time to think about buying when this happens. On the other hand, if the short-term line crosses below the long-term line, we call that a bearish crossover. This signals that the market might be entering a downward trend, and it could be a good time to sell or at least avoid buying. Here is a quick example. When you see the 12-day line crossing above the 26-day line, it suggests that the market could be starting to go up. It is the kind of signal that makes traders take notice. But if the 12-day line moves below the 26-day line, it is usually a sign that things might be going down. This is when traders often think about selling or getting out of their positions. So now we know how to identify trends, but what about actually entering and exiting trades? For entry points, you want to wait until you see that bullish crossover where the short-term line crosses above the long-term line. This tells you that the market might be gaining strength, and it is a signal to think about buying in. For exits, you want to watch for a bearish crossover where the short-term line moves below the long-term line. This signals that the trend could be reversing, and it might be time to lock in those gains or cut any losses before they get bigger. It is always a good idea to set some rules to protect yourself. One way to do that is by setting a stop loss. This is a way to automatically sell your position if the market moves against you. For example, you could set a stop loss just below a recent support level. If the price drops that low, you know that it might keep dropping, and you do not want to stay in that trade. The long-term exponential moving average is another good reference point for setting a stop loss. Additionally, when using chart patterns to set stop losses, it is crucial to understand the dynamics of each pattern. For example, if you are trading a head and shoulders pattern, a good place to set a stop loss would be just above the right shoulder for a bearish trade. This way, if the price moves back up above that point, you can exit the trade before further losses occur. Similarly, in a double top pattern, setting the stop loss slightly above the peaks helps you manage your risk if the price fails to follow through on the anticipated downward move. For continuation patterns like flags and pennants, placing the stop loss just below the flag or pennant structure ensures that if the breakout fails, your losses are minimized. In triangle patterns, you could place a stop loss just beyond the trend line opposite to the breakout direction. For example, in an ascending triangle, if the price breaks upward, placing a stop loss below the ascending trend line can help you manage your risk effectively. By combining these strategic stop-loss placements with the signals from exponential moving averages, you can significantly improve your risk management and overall trading performance. Setting stop losses in a disciplined manner not only protects your capital, but also helps reduce emotional decision-making during trades. Another way to make this strategy even stronger is to combine the exponential moving averages with other tools. One helpful indicator is the relative strength index, which can tell you if the market is overbought or oversold. For example, if you see a bullish crossover and the relative strength index shows that the market is oversold, it makes for a strong buy signal. This combination of signals can help you make more confident decisions. You could also use something called the Moving Average Convergence Divergence Indicator, or MACD. This tool is based on the difference between two exponential moving averages. If the MACD line crosses above its signal line and you also have an exponential moving average crossover, it is another sign that the trend is strong. You want to look for these confirmations whenever possible. And do not forget about volume. Volume tells you how many people are trading and how much conviction there is behind a price movement. If there is high volume when you see a crossover, it means there is strong interest and makes the signal more reliable. High volume during a pattern like a breakout from a triangle or a head and shoulders reversal is a strong indicator that the move is likely to continue in that direction. For example, when you see an ascending triangle pattern followed by a significant increase in volume as the price breaks out, this suggests that many traders are backing the move, which can lead to a sustained trend. On the other hand, if the volume is low, that might mean the trend is not as strong and could reverse. Low volume during the formation of a double top or double bottom could indicate weakness and a higher likelihood of a failed pattern. Watching the volume helps confirm whether the pattern is reliable or if it could be a false signal. Always make sure to pay attention to volume as it can provide crucial context to the chart patterns and exponential moving averages, giving you a much clearer idea of whether to trust the signal or stay cautious. This strategy works across different markets and time frames. If you are a day trader, you might want to use shorter exponential moving averages like 5-day and 10-day. These are more responsive and help you make quick decisions for short-term trades. Along with these moving averages, you may also want to look out for common chart patterns like flags, pennants, and triangles that can help confirm whether a trend is worth following. For example, if a bullish flag forms and the 5-day exponential moving average crosses above the 10-day average, it could be a strong signal to enter a trade. If you are more of a swing trader, you could use the 12-day and 26-day exponential moving averages that we talked about. They are good for riding trends that last a few days to a few weeks. Chart patterns are especially helpful in swing trading. Patterns like double tops, double bottoms, and head and shoulders can add a layer of confirmation to the signals from the exponential moving averages. For example, if you spot a double bottom pattern forming and then see the 12-day exponential moving average crossing above the 26-day average, it might be an excellent opportunity to enter a trade as the market is showing signs of strength. For long-term investors, the 50-day and 200-day exponential moving averages are more commonly used. These help you identify the big trends that last for months or even years. Long-term investors also benefit greatly from recognizing chart patterns like ascending triangles or cup and handle patterns. If the 50-day exponential moving average crosses above the 200-day average, and it is accompanied by an ascending triangle breakout, this is often referred to as the golden cross and signals a very strong bullish trend. These larger patterns, combined with the exponential moving averages, provide you with a comprehensive picture of where the market might be headed over a long period. When using this strategy, there are a few common mistakes to avoid. One big mistake is ignoring the bigger picture. Even if you see a crossover, you want to make sure you understand what else is happening in the market. Big news or economic events can easily make even the best signals go the other way. Another mistake is overtrading, especially in choppy markets. Not every small crossover is worth a trade. Make sure the signals are clear and confirmed before you act. Lastly, always remember to use stop losses. No one can predict what the market will do with complete certainty, and even the best trades can turn against you. Having a stop loss in place will help you keep your losses small and protect your capital for future trades. To fully understand how to make the most of stop losses, it is crucial to consider the different chart patterns that may influence your strategy. Chart patterns can provide a visual representation of where to expect resistance or support levels, which in turn can help you determine where to place your stop losses. For example, if you are trading a head and shoulders pattern, you may want to set a stop loss just above the right shoulder. This is because a move above this point would indicate that the bearish reversal pattern is not playing out as expected. Similarly, in a double top pattern, placing the stop loss slightly above the peaks will protect your position if the price does not drop as anticipated. When dealing with continuation patterns like flags and pennants, it is important to set your stop loss just below the consolidation area. This ensures that if the breakout fails and the price moves in the opposite direction, your losses remain limited. In the case of triangle patterns, such as ascending or descending triangles, you should set the stop loss just beyond the trend line opposite to the breakout direction. For instance, if an ascending triangle breaks upward, the stop loss should be placed below the ascending trend line, ensuring that if the breakout is a false signal, your risk remains minimized. In wedge patterns, the stop loss can be set just outside the converging lines of the wedge. A rising wedge, which is typically a bearish pattern, would require a stop loss above the upper line of the wedge to protect against a potential breakout in the opposite direction. Conversely, in a falling wedge, the stop loss should be placed below the lower trend line to protect against unexpected downward movement. By understanding the specific characteristics of these patterns and how they interact with price action, you can make more informed decisions on where to place your stop losses. This not only helps protect your capital, but also allows you to trade with greater confidence, knowing that your risk is being managed effectively. It is also helpful to understand how different chart patterns can guide you in setting effective stop losses. For instance, when trading a head and shoulders pattern, placing your stop loss just above the right shoulder can help limit losses if the price moves unexpectedly. In a double top pattern, Positioning the stop loss slightly above the two peaks can protect you in case of a sudden reversal. For flags and pennants, the stop loss should ideally be set below the consolidation area, ensuring that if the breakout fails, your risk remains minimal. In wedge patterns, where the price is moving within two converging lines, you can set your stop loss just outside the wedge, opposite to your trade direction. For triangle patterns, whether ascending, descending, or symmetrical, placing a stop loss just beyond the key trend line helps manage your exposure if the breakout does not hold. Understanding where to place these stop losses is crucial to improving your overall risk management and keeping your capital safe. So, how do you get started with this strategy? The best way is to practice. Most trading platforms offer a demo account that allows you to trade with virtual money. Use this to get comfortable spotting crossovers and making trades without risking your own cash. Practice is key. You want to get used to the process so that when you do start trading for real, you will feel confident in your decisions. It is also a good idea to keep a trading journal. Write down every trade, including why you entered and why you exited. Note down how you felt and what you noticed at the time. When you look back, you will start to see patterns, and this will help you get better. A journal is like a personal coach that helps you improve. You will begin to notice chart patterns emerging in your trading journal as well. For example, you may recognize that each time you saw a double top pattern forming, it was a good time to consider exiting a trade, as the price usually dropped afterward. Or perhaps you will see that each time there was an ascending triangle and a bullish crossover of exponential moving averages, it often led to a successful buying opportunity. The more you record and review your trades, the better you will understand these patterns and how they affect the market. Chart patterns such as head and shoulders, double tops, flags, and wedges all leave clues about the next likely movement of the market. By journaling your experiences with these patterns, you can start to develop an intuition for how the market behaves. When you see the same pattern occurring multiple times in different trades, and it consistently results in a predictable movement, you can use that knowledge to make better decisions in the future. Keeping a trading journal also allows you to see which chart patterns work best for your trading style. Maybe you notice that you have a good track record with pennant patterns, but tend to struggle when trading with wedge patterns. This kind of insight is invaluable because it helps you focus on what works well for you while avoiding what does not. Experimenting with different combinations of exponential moving averages can also help. Try using different time frames, maybe shorter ones for fast-moving markets or longer ones for more stable trends. Additionally, integrating various chart patterns can significantly enhance the performance of exponential moving averages. Patterns like head and shoulders, double tops and bottoms, flags, pennants, triangles, and wedges can help you determine more accurate entry and exit points. For instance, if you see a bullish wedge forming in conjunction with a short-term, exponential moving average crossing above a long-term one, it can be a strong signal to enter the trade. Similarly, a bearish pennant pattern might confirm a downward crossover of exponential moving averages, suggesting a selling opportunity. Understanding these patterns and using them in combination with exponential moving averages can give you deeper insights into the market dynamics. Finding the combination of exponential moving averages and chart patterns that works best for you is part of becoming a successful trader. To wrap it all up, the exponential moving average strategy is a simple but powerful way to identify trends and make more informed trading decisions. By watching for bullish and bearish crossovers and combining these signals with tools like the Relative Strength Index, the Moving Average Convergence, Divergence, and Volume, you can create a solid trading plan. Start by practicing with a demo account, use a trading journal to track your progress, and always make sure to manage your risk with stop losses. The key to success is practice and discipline. If you keep working at it and continue learning, you will improve over time. The market can be challenging, but with a good strategy and a plan, you can make more confident decisions and hopefully see better results. Good luck out there, and remember to stay patient, stay focused, and keep learning. If you have any questions or want to share your experiences, feel free to do so. The more we learn from each other, the better we can all become at this exciting journey of trading.